All right, well, we'll get started just so that we allow for enough times for questions and answers at the end. Welcome, everyone. So excited that you're able to join us today for the Beginner's Guide to Buying Your First Home with Mountain America Credit Union. We have a special guest providing this education and presentation today. We have Brett, and I'll have him do his self-introduction in just one moment. I do want to remind you guys that with getting points and credit for attending today's webinar, please go into your Wealth Steps account and check that activity off. That is new this year, along with all the other workshops that we are doing, is you'll go in and select those that you're attending and get credit for those there. So you no longer have the sign in the chat. So just be looking for those. And as Brett is going throughout his presentation today, feel free to put questions or thoughts in the chat, and we will revisit those at the end of today's presentation. Without further ado, Brett, hi, welcome. Thank you
Hello.
so much for being here.
Yeah, thank you. Just want to make sure you can hear me and you can see the slideshow. Okay, good.
Yep, you are all good to go.
So just a little bit of my background. I've been doing mortgages now actually today is my 12-year anniversary at Mountain America. So I've been doing mortgages here at Mountain America as of this exact moment, 12 years, and doing mortgages overall for 19 years. So it's been a hot minute since I've been doing that. So yeah, and I love it. I love the process of helping people to figure out what they want to do, guiding them through the process of buying a house, and particularly first time home buyers. Always exciting to be a part of that process. So. I'm down here in Utah County, which I know that's maybe a bad word for all my Salt Lake County people, but you guys all know that we've got lots of branches there in Salt Lake County as well. So let's just jump right into it. So the goal of today's meeting is I just kind of want to go over the general process of buying a house. Okay, the steps that go into it, um, the so that you guys have a plan to know how to get it. It can be a very daunting thing to buy a house. This is a massive investment, and it requires a lot of planning and preparation. And a lot of people get worried about the process, that they never get started. But it can become a very comfortable process that you're able to work your way through. So let's jump right into it. So what is the process of buying a house? Generally, we're going to be going through these 5 steps in getting in a home. I always like to suggest that the first thing that you do is you meet with a mortgage loan officer. Okay, Mountain America, we have branches throughout Utah, Salt Lake County, Utah County, all the different counties, where you can meet with a loan officer and they'll go over your individual situation. We'll talk about your situation, your credit, your income, your savings, your situation, so that you can make a plan to get into a house. After you've made that meeting and made a plan, generally there's some preparation that has to go into preparing for the cost of getting into a home. We've got some great loan programs that don't require a massive amount of down payment, but there's generally some money that you have to save up to in order to buy a house. We're not talking about tens of thousands of dollars, but there is some savings that needs to happen, and we'll be going into that in more detail. After you've done all the preparation and you're ready to go, we get you pre-approved. That's where we run credit on you. We verify everything and make sure that you're good to go, give you a letter so you can get out there and then go for the next step of shopping for a home. Go look at all the different houses that you're interested in. Meet with your realtor to help you to make a contract with the sellers. And then after you've found a house and you're under contract, then we get really busy on my side of the process, and we start processing your loan. And so we'll go into all of these these steps a little bit more in detail as we go through this. But that's kind of the general overview of what it looks like to buy a house. So let's see. Before you start the process of buying your home, it's important to realize what is your dream. Okay, it's very tempting to look at those houses up on the east side of the valley, up on the side of the mountain, and say, "Man, that would be an awesome house to have." Uh, I want a basketball court underneath my garage, and I want an 18-car garage with a 5 acres in the back with horses running around and 15 bedrooms and 15 bathrooms. That would be amazing, right? But along with those amazing houses come, quite honestly, amazing mortgages that you have to deal with, right? And so a lot of times buying a house means figuring out what you actually need, what house meets your needs for the time frame that you're going to be there. And that's something I always like to point out to people. When you're buying a house, particularly first-time home buyers, you don't necessarily need to worry about buying the house that has the big gathering rooms for all of your grandkids to come hang out in, and you might not even have to worry about the school district if you're only the average first time home buyer lives in their house for 3 to 5 years, and if that kind of fits your mold, buying a house in worrying about the school district that you're going to live in, and you don't even have kids yet, doesn't really matter. And so you might be able to get a small condo in a part of the that meets your needs, because you're only going to be there for 3 to 5 years. But maybe if you think you're going to be there for 20 years, then you might need a little bit more of a house. And so evaluating what your needs are, what you can afford, sometimes that adjusts what you should be looking at. So what are the costs of purchasing a home? The first thing, your monthly mortgage payment includes your principal, interest, taxes, insurance, and assessments. Assessments would be like HOA fees, okay? So each month you're going to be making a payment of principal and interest, taxes, insurance, and HOA. We need to make sure that you can afford that monthly payment. In addition to that monthly payment, you have money that you have to pay up front, okay? So there's earnest money. When you make an offer on a house, you generally have to pay earnest money to the sellers, or it actually really goes to the realtors. This is just money that helps them to know that you're serious about buying a home. Once you're under contract on that house and you've given that earnest money, you're going to want to do some inspections on the house. Those inspections the inspectors spend about 3 or 4, sometimes 5 hours going through the house and giving you a detailed list of everything that's wrong with the house. You've got a loose plug here. You've got a weird plumbing situation there. You've got missing caulk around the window. I don't know. There's always going to be a list of different things that are going on with the house. Even a brand new house is going to have a list of things. And so an inspector can help you to evaluate those things. An appraisal also helps you to know what the value of the home is. And so, and make sure that you're not paying too much for the home. The closing costs, there are costs of getting a loan. Okay, so we need to understand what those closing costs are, what the down payment is for the different types of loans, and what loan you're going to be getting. We have to set up an escrow account for your taxes and insurance. There's interest that has to be collected up front. The cities and utilities, there's usually some fees associated with getting those set up. And so there's cash that needs to be accounted for when you're buying a house. When you meet with a loan officer, what we're going to do is we're going to talk to you about your finances. We're going to get to know what your situation is, what your income is, what your monthly debts are, what you're comfortable with as far as a monthly payment goes, and so that we can get you moving in the right direction. Evaluating their different loan options, how much money you're going to need for that down payment, how much money are you going to need to have saved up. And that's a big part of that conversation, is evaluating all of these different options so that you know what you're getting at, what you can plan and prepare for. It's very common where I'll sit down with somebody who says, I'm ready to make an offer on this house. And I sit down with them and I'm like, ooh, you need to do A, B, and C. And I would have loved to have sat down with them 6 months ago, a year ago, to give them that list of things that they need to do. Okay, you want to buy a house in a year? Here's A, B, and C that you can do to have yourself really well prepared to buy a house. And that's part of that meeting with a loan officer to get yourself ready to buy a house. Later in the process, after you've met with a loan officer and kind of gotten a plan together, we'll get you pre-qualified. A pre-qualification means that you have a letter now that says you are pre-qualified for X amount of dollars, $400,000 purchase price, $350,000 purchase price. And with that letter, you take it out there and you go with your realtor and you start looking at homes. It's very important that you commit to staying underneath that price range, though. I can guarantee you, as you start looking at houses, that the more expensive houses, they're almost always a little bit cooler. They're a little bit better. They just have a little bit better stuff. But once you've established that dollar amount that you need to stay under to be able to be comfortable with that payment, make sure that you and your realtor are committed to staying within that price range, because it's very easy to get carried away as you start looking at homes. When you meet with a lender, there's some great things that you should be looking at to help evaluate whether the lender is a good fit for you, and to evaluate what your options are. First thing is, how much can I qualify for, right? So we want to know what the purchase price is. What can I be looking for? It doesn't do you any good to be looking at $600,000 houses if you can only qualify for a $450,000 house kind of thing. When we first meet in the beginning process, it's a good idea to understand where your credit scores need to be. Generally speaking, if you've got a credit score over 680, you're in a good spot to start looking for a home. If you're under 680, I would tell you that start work on trying to get that credit score above 680. There are still some options to buy a house, even down to credit scores around 620, even in some situations down to 600. But your options are fewer and farther between, and not as good of options until you're up to that 680 mark. Now, I wouldn't tell you to stop working on your credit once you hit 680. Try to get higher. The higher, the better, the more options you have available to you. But that's a good target as far as where credit is. And if you're struggling to know what you can do to improve your credit scores, Mountain America has some great financial guides. I would assume that we'll probably even be meeting with you guys at some point in the future to kind of go over things to do to build up your credit. Other things to look for with the lender is what kind of programs do they have. Mountain America specifically, we have some great first-time homebuyer programs, but there are other loan programs that are available as well, like Utah Housing, FHA, VA, USDA. There's lots of different loan programs that are available, not just for first-time homebuyers, but also that can help you to get into a house with very little cash out of your pocket. Closing costs. That's a big part about when you're working with your lender, is understanding what are the costs of getting a loan. How much do I need to be preparing for? Who's going to pay those closing costs? Sometimes you can get sellers to pay closing costs. Sometimes you can't. You need to understand what those details are for the specific loan program that you're looking at. Some loan programs have very low closing costs. Some loan programs have high loan closing costs. And so being prepared to understand what option meets your needs the best, so that you're prepared with those closing costs. Upfront costs, we talked about that just a little bit, as far as setting up escrow accounts and taxes, insurance, interest, all those things need to be prepared for. Private mortgage insurance, that's another good question to ask. Most loans that don't have at least a 20% down payment require private mortgage insurance. And I'll just give you a little quick preview of what private mortgage insurance is. It's basically an insurance policy that helps us as the lender recover our loss when you don't have a big down payment. So for example, if you have a house that's worth $600,000 and you only owe $400,000, our risk is very low. We don't require this extra insurance. But if I have somebody who owes $600,000 on a house that's worth $600,000, our risk is higher. Private mortgage insurance helps us to compensate for that risk. And so it's good to understand what the private mortgage insurance is going to be for the loan program that fits for you. For example, Mountain America's first-time homebuyer program, we actually don't require mortgage insurance on that program. We can go into those details as well with you. It's good to understand what the total payment is. A lot of times, if you're doing searches on the internet, you'll find, okay, what's a mortgage payment for $400,000? And it pops that up, but it might be leaving off your tax payment, your insurance payment, the HOA fees, mortgage insurance. And so your $2,000 a month payment all of a sudden jumps up to $3,000 a month. You're like, oh, I can't afford that payment because it wasn't including all of the things that were included in buying a house and your total mortgage payment. So it's important to understand what is included in that total mortgage payment so that you're staying within the means that you have. Debt to income ratios. Debt to income ratios are vary depending on the different types of loan programs that we're going to be looking at. But generally, we need to keep your total debts less than 43% of your gross monthly income. So the basic math there is if you're making easy math, $10,000 a month, all of your debt payments need to be less than 43%. So in this case, $4,300. That would be including your mortgage payment. And so we'll go over that math with you in your specific situation when you sit down with us. Adjustable versus fixed rate. That's another great question, particularly in today's environment. Interest rates are quite high compared to where they were a couple of years ago. They're actually decent compared to where they were in the 80s, but they're higher than where they were before. And so adjustable rate mortgages have become a more enticing options these days. Basically, what an adjustable rate mortgage means is that your interest rate is only fixed for a certain period of time, in most cases 5 or 7 years, and then your interest rate starts adjusting with the market at that point. Versus a fixed rate mortgage, your rate stays the same for the entire 30 years of your mortgage. And there's pros and cons. It's not universally going to say that, hey, never get an adjustable rate mortgage or never get a fixed rate mortgage. There's pros and cons with both of those situations, and your individual situation is going to determine which is the best for you. With that pre-approval, we are going to look at your credit history. We want to know what your employment history is. On credit history, we want to see that you have about 3 accounts on your credit in most situations, that you haven't missed any payments in the last 12 months, hopefully. Hopefully no collections, things like that. Now, not to say that you can't buy a house if you've had a late payment or you've had a collection on your account. That's not necessarily the case, but we're hoping that we're going to be kind of shooting for that as a goal, right? As far as your credit history goes. Employment history, we want to see that you've had a job for at least 2 years, but that doesn't necessarily mean that you have to have had the same job for 2 years. So right now you're working at the county, but if you were working, well, I don't know, what's another employer? The city, Salt Lake City, 6 months ago, and now you're working at the county, but you have a 2-year work history, that's still okay. Now, things that do kind of mess us up with the work employment history is anytime we're looking at variable income. So that would be like overtime, commissions, bonuses, self-employment, piece rate, any of that kind of stuff does require a longer history. And so we'll definitely want to evaluate that with you when we sit down with your individual situation, understand what your variable income is. Can we use it, or do we just need to be looking at your base income, that kind of stuff. Monthly debt payments, that's where a lot of times we need to work on some things like that. If you've got big credit card payments, things like that, sometimes people need to work on those to get to your debt to income ratios in line so that we can buy a house. Sometimes it requires you to kind of make some choices in life, right? So if you've got a $500 payment on your razor and that's going to prevent you from buying a house, but you want to have a house, sometimes you have to sell that razor to be able to afford the house. Not always the case, right? But that can be a situation where you can make a choice to say, all right, I want a house more than I want a razor, so I'm going to sell that, get some cash from that, get some of the debt out of there. Now I can buy a house, that kind of thing. It's a very common scenario where we're helping people to make those choices to be prepared to buy a house. Sometimes, like a guy I met with the other day, he's like, all right, hey, I've got 2 trucks. I only need one. I need some money for some down payment. I'm going to go sell that truck. And so that will be something that comes up into the conversation as far as how to get into a house as well. So when we are looking at a borrower to get ready to buy a house, we're looking really at these 3 things: your capacity, your credit, and your collateral. Okay, so capacity, that's kind of what we talked about there in the debt to income ratios. Do you have the ability to repay this loan? I don't want, if you make $5,000 a month and your mortgage payment's going to be $4,000 a month, that's really, you don't really have the capacity to make that mortgage payment every month and still eat and pay insurance and gas, right? That debt to income ratio helps us to evaluate that. Credit, we want to see that you have a history of making payments on time, that this isn't your first time of first experience of making sure you're able to make a payment by the due date each month. Collateral, that's generally talking about down payment, but in a situation where we can get into a house with very low down payment, it's also talking about, is this a good house? For example, if you've got your shack down by the river that has a big hole in the roof and it floods every spring, a cool house, you can get it for $100,000, but it's not a good enough house that we can lend on. It has to be a functional house. Now, with that said, we can lend on some really ugly houses. I mean, I've seen houses with that pink carpet and the pink toilet that grandma had back in the 70s. I can lend on that house because it's a functioning house. But if it's been torn up, that might not be a house that we can lend on. We're looking for a stable 2-year work history. Oh, well, we pretty well talked about this stuff here. So, different loan programs. Okay, so Mountain America has some great loan programs. We have our first-time homebuyer program that I've mentioned here. We also have a great program for like first responders. We have a teacher program, dentists and doctors. We have some programs just kind of helping out those specific situations. This is what I would call a portfolio program. You also have your government programs, which would be generally FHA and VA. Also USDA rural housing fits into that. These are different government programs that help us to get you into a loan, into a home. And then there's conventional loans. Conventional loans, this is Fannie Mae and Freddie Mac's money that we're using to lend out to you. And then you have local government programs. Utah has a great program called Utah Housing that helps you to get into a house. Each of these different programs have different pros, different cons. Not one program is universally better than the other. And that's where sitting down with a loan officer and understanding what the pros and cons are, how it fits into your situation, really helps you to make that plan so that you are going down the right path for yourself. To kind of talk about our first-time homebuyer program, because I think it's kind of exciting, is our Mountain America's first-time homebuyer program. The biggest aspect of that loan is we don't require a down payment, right? So if you're buying a house for $425,000, we do require that you put at least $1,000 into that. Oops, I went the wrong direction. $1,000 of your own money into it. So we have to have some skin in the game, if you will. Whereas with an FHA loan, they require a 3.5% down payment. Okay. Interest rates usually a little bit higher on our first-time homebuyer program, but we don't require mortgage insurance on our first-time homebuyer program. So that saves us a ton of money. So even though the interest rate's a little bit higher, the monthly payment is usually a little bit lower than you would have on an FHA loan. The biggest thing, though, is you don't have to have all of that cash. Okay. And that's usually where our first-time homebuyer program really shines for most first-time homebuyers, is we are able to get you into that house without all of that down payment money that you have to have with most of the other loan programs. Closing. So one of the big things that goes into being prepared to buy a house is being prepared for the cost of funding your loan. Okay, we've got the down payment. That's one aspect of it. but there's also the closing costs. One of the ways that you can help be prepared for those closing costs are, first of all, saving, right? A target that I would tell people to plan for is having somewhere between 2 to 5% of the purchase price available for you, right? So if we're talking about a $400,000 house, having 8 to what is $8 to $20,000 available to you is going to be a great spot for you to be. So if you can build up that kind of savings, that's fantastic. That's not necessarily required though, because you can negotiate with the sellers to pay your closing costs, right? You can say, hey, sellers, I only want to buy your $400,000 house if you will pay 3% of the purchase price towards closing costs. And if you're able to, you and your realtor are able to negotiate that with the sellers, then you can reduce the amount of cash that you have to come up with. Now, if we rewind back to 2020 and 2021, when the real estate market was just insane, it would be pretty rare that you would be able to negotiate for the sellers to pay closing costs in a situation like that. In today's real estate market, we're seeing sellers pay closing costs, maybe not that full 3% number. That's not all. I'm not seeing that very often right now, but 1 or 2% of the purchase price, sure, we're seeing that from time to time. But having your money saved up to be able to meet that, that's always the best option. And hopefully we can still negotiate with the sellers, and then you have some cash in your pocket at the end of the day. You can also ask family members for a gift, right? I mean, if you've got parents or grandparents or something like that that really like you and want to help you to get into a house, we see oftentimes that buyers are getting a gift from a family member to help them to get into a home as well. Real estate agents. Okay, so real estate agents are a great resource to helping you to buy a house. They are, I like this word, they're an expert guide. Okay, so they are going to help you to take every house that's in the real estate market and narrow down to what is really the homes that are the ones that you might be able to look at, right? We don't need to go look at every single house in Salt Lake County or Utah County to evaluate what's going to be the house you want to buy. Meeting with a good real estate agent can help you to evaluate what houses are going to meet your needs. Take that list of things that you really want to have in a house and make sure that you're understanding the difference between what your wants are and your must-have lists, right? And finding those houses that have those must-haves and evaluating whether the wants that are on your wants list are how critical those are and what it's going to cost you to get those wants versus the must-haves. You spend a lot of time with a real estate agent. They're going to be going with you to go look at quite a few homes. And so you want to find a good real estate agent that is going to be your advocate and really be willing to spend the time that you need to have to be able to find the right house. Now, I would caution against any old real estate agent. Find a really good one, okay? Right now and historically, I think the number is like 80% of the transactions that are done in real estate are done by 20% of the realtors. 80% of the realtors are doing 1 or 2 transactions a year. And if I were buying a house for my first time, I would definitely want to have one of those realtors that really understands the market. They're doing lots of transactions. They are in tune with what's happening out there. If you're only doing 1 or 2 transactions a year, it's hard to stay on top of what's happening in the market. And so take the time, find somebody who really knows what they're doing, not just the guy that passed a test. So they can really be beneficial in negotiating where the sellers could pay your closing costs. A good realtor knows what houses to make an offer on, how much you can ask the sellers and to pay in those closing costs so that can reduce the amount of cash that you have. They're good at making that negotiation. Earnest money. So I talked about this a little bit earlier. When you finally find that dream home and you are ready to, you've made an offer on the house, you give them, when you sign your contract, you're negotiating an earnest money amount. Okay, usually in most cases, somewhere between $2,000 and $5,000. Bigger homes, $1 million home, you might be seeing $10,000 to $20,000. But your average $400,000 to $500,000 home, that's usually $2,000 to $5,000 that you're putting up as earnest money. This is showing everybody in the transaction that you are serious. Now, in that earnest money contract, there are details that say you can get your money back if you end up not wanting to buy the house. So, for example, there's a due diligence date. And so that means that after you've done your inspections and things like that, as long as you decided to back out of the contract before a certain date, you can get your $2,000 to $5,000 back. If there's issues with your financing, if there's issues with the appraisal, you can get your money back. But you need to understand what those dates are and how those are affecting you. That earnest money is usually held by your realtor. Sometimes the title company holds it as well. But that money, that $2,000 to $5,000 that you're giving as earnest money, is not just kind of extra money. It's money that's a deposit towards either your down payment or your closing costs for the transaction. Okay, there are even situations where you can get the earnest money back. So you say you gave a $5,000 earnest money deposit, but your required cash injection is only $1,000 for the transaction. You might be getting a check back at closing for $4,000 because you gave more of a deposit than was required for the transaction. So, yeah, earnest money. Closing costs. We talked a little bit about this already, but there are the details of the closing costs are your lender costs. Okay, in Mountain America's situation, it's pretty simple. We basically just have an origination fee and a processing fee. In addition to that, you have fees for your appraisal and credit report, and then there's title company fees, and that would be under the category of closing costs. And then you have your prepayments as well, which are paying some money for your first year's insurance premium, interest for the rest of the month in which you close, or property taxes. You guys actually, all of you employees, Salt Lake County, love property taxes, because guess what? That's where you guys are getting paid, is through our property taxes. And when we do a mortgage, we are collecting some money and putting it into an escrow account for those taxes, because we want to make sure our county employees get paid every couple of weeks, right? So that's your closing costs. I mentioned earlier, you can negotiate with the sellers to pay those closing costs. They usually range between 3% to 5%, and we'll definitely go over those details as we look at the different loan options that you, depending on your situation, how much money you need to be preparing for those closing costs if you can't get the sellers to pay those. There are some costs that need to be paid up front. So generally, most of the costs are paid at the time that you're signing papers, the day of closing. There are a couple of things that get paid up front. Your appraisal, for example. You need to be prepared to pay for that appraisal up front, because that's a cost that happens before closing. Home inspections, those are usually $500 to $600. That has to be paid. Those have to be paid at the time of the inspection. And so be prepared for those costs. There's a few $1,000s that need to be paid in addition to your earnest money, and then the rest of it can be paid at closing. A closing disclosure is a document that we send out as a lender to you a minimum of 3 days before closing. We don't want you to have any kind of surprises at closing. We want you to know exactly what you're getting into before you go to closing. So you get this disclosure that details out all of those closing costs before you even go to sign them at the title company. And then we go over that closing disclosure again at the title company to verify, to make sure that you understand exactly what you're getting into. Like I mentioned earlier, that usually ranges between 3 to 5. 6 is a little bit on the high side. So there are ways that you can look to try to save money in your costs. You can definitely shop around different lenders. I think Mountain America is the best. I've been here for 12 years, so I genuinely do believe that we have some amazing programs, and it's kept me around here. But you can shop between us. Go talk to Zions Bank. Go talk to Central Bank, Chase Bank. Go see what other lenders have to offer you. But it's important as you're shopping between different lenders that you understand what you're shopping, right? So if you come to me and say, hey, Mountain America, I want your best interest rate. Well, I might tell you what our best interest rate is, but it might not be the right loan program for you. So you're not just shopping rate, you're looking at rate and fee together because those are intertwined. There are situations where you can say, you can have the very lowest interest rate, but I'm charging you an extra $10,000 or $20,000 to have that lower interest rate. Well, that might not be your best interest if you're going to be refinancing in the near future or something like that. You can definitely shop title companies. Generally speaking, when we're shopping title companies, we're saving a couple of $100, not a couple of $1,000, but it's definitely worth shopping. You can close towards the end of the month. When we close, when you sign loan papers, we're going to collect interest for the rest of the month which we close. So for example, today's the 18th. If you were buying a house today, we'd collect interest for the next 12 days. Your first mortgage payment would be due on June 1st. Now, if you closed on the 30th of April, again, your first mortgage payment is going to be due on June 1st, but now I only have to collect 1 day's worth of interest. If you closed on May 1st, though, I'd collect 31 days worth of interest up front on day closing, but now your mortgage payment's due July 1st. And so we're accounting for every day of interest in this scenario. It's just shifting where the money is due. Is it due at closing, or is it due a month later? But closing towards the end of the month can reduce how much cash you have to have that day. You're just going to have your first mortgage payment a little bit sooner. You can ask us if you have discounts. So for example, I mentioned earlier that we have to have an appraisal. Well, right now, Mountain America has a promotion where we're going to pay for the cost of your appraisal on a purchase transaction. So that's a $500 savings that you can get through Mountain America Summer Promotion. Now, that promotion ends on contracts that we get through July 31st. We have to close by the end of August. So that's how the details of that promotion. But periodically, lenders offer promotions to help you to get into your house. On the day of closing, so again, let's rewind. We've met with your loan officer. You have evaluated your different loan options. You've prepared for that. You got pre-qualified. You went out there, shopped, found a house, did all your due diligence, and figured out the house is in good shape. We as the lender, we did all our evaluations. We've given you clear to close. Now you're ready to go sign papers at the title company. Exciting day. You want to make sure you know exactly where you're supposed to be going and what time you're supposed to be there. You're going to be sitting down with your real estate agent. Your lender's probably going to be there. The escrow officer at the title company is going to be there, all waiting for you to sign those papers. We're going to go over all the papers, particularly the closing disclosure that has all of the numbers on it. Make sure that you know exactly what you're getting into. Answer any questions that you have. You'll usually walk out of the closing with wire instructions from the title company so that you know how to send your money to the title company for your down payment. That's usually done through a wire. It's important that you understand that there can be wire fraud. Okay, so wire fraud meaning that somebody has fraudulently told you to send your money to the wrong place. So for example, the way that usually has happened in the past is some hacker has gotten into somebody's email and been watching that you're buying a house, and they email you and say, hey, you need to wire us $10,000 and here are the wire instructions for your closing. And it looks like it's maybe coming from your realtor or something like that, but it's really coming from some fraudster in Russia. And once that wire money is gone, it's usually not recoverable. And so we want to make sure that you're getting the wire instructions directly from the title company so that you're sending the money to the right place. Homeowners insurance. This is the insurance you get in case the house burns down. Okay. Mountain America has a great insurance division. We can help you get quotes for different insurance providers. You can get insurance from wherever you need to, though. Geico, Allstate, State Farm, all of those great people can give you an insurance quote. It's tempting to look to try to save money in insurance, and you definitely should be shopping, but make sure you understand what you're getting when it comes to insurance. What we're looking at is from the lender's perspectives, we want to make sure that that if your house burns down, that we can get the house be rebuilt, and that's what we're looking for. Other things that you might want to consider, though, is does this insurance policy cover my stuff, right? So if you have a lot of jewelry or expensive paintings or something like that, you want to make sure that your insurance policy is covering those things. If the house has a trampoline or you're going to be adding a trampoline, you want to make sure that it covers that liability. Understand how that insurance policy covers you. For example, like a common one is earthquake coverage, right? Most insurance policies don't cover earthquakes. And so your specific house might not be at high risk for earthquake damage, right? If it's been built in the last 20 years, probably not a huge earthquake risk. But if it was a cinder block home built in the 40s, your earthquake risk is significantly higher. You might want to pay for a more expensive policy to cover that risk. Have those conversations with your insurance agent. Make sure you understand what coverages you're getting. Let's see. You can definitely ask about discounts with insurance. Usually if you have an auto policy and you can get a discount on your auto policy if you have a homeowner's policy with them as well. And make sure you're understanding all of your needs as far as that insurance goes. Okay, on closing day, when you sit down with the title company, you're going to review and sign all of the loan documents. One thing to really be important to be aware of is that they do have to have a valid ID. Okay, so if your driver's license expires, this actually happened to me. I bought a house on my birthday, and it happened to be that my driver's license expired on my birthday. And well, it actually always expires on your birthday, but it was that year that it expired on my birthday. I was actually ready to go sign the papers. I'm like, crap, my ID is expired. Fortunately, I had a passport that I could use, but I could have been in a situation where I wasn't eligible to get my documents notarized and buy my house because my ID expired on that day. So make sure you understand the expiration date of your ID and you have a valid ID. Let's see. So what are the things we need to do to be prepared to buy a house? Sit down with a loan officer. I think that's the number one thing that you can do at this point. Sit down, go over your finances, talk about your income, talk about your debts, talk about the things that you need to be doing to prepare. And then get on board with what that's going to look like. One of the big things that I see is payment shock. Okay, so if your payment shock basically is a scenario where, say you're paying $1,000 a month in rent and your mortgage payment is going to be $3,000 a month. If you're really struggling to save any money at all when you have $1,000 a month rent, you're really going to struggle when you have a $3,000 a month mortgage payment. And so one of the things you can do as you're preparing to buy a house is look at your finances and say, okay, I want to have a $3,000 a month mortgage payment. Where am I going to come up with that $2,000 gap between what I'm paying for rent and what I will be paying for a mortgage? And figure out what you need to cut out of your life and what expenses you need to cut out so that you can do that. The side benefit of that is when you do that for a few months, you're going to build up your savings pretty rapidly, right? So if you've got a $2,000 payment gap and you're able to save $2,000 a month for a few months, that's going to build up your savings. That's going to be really beneficial. Figure out what you can afford, right? Reduce that. You might not be getting the biggest, coolest house ever, but you're going to get into a mortgage that you can afford and you're going to feel comfortable with. Prepare for those upfront costs. Schedule a time to meet with your loan officer so we can go through all of those details of getting ready to buy a house. Now, I'm going to ask you guys, if you want to, please get out your cameras, your phones, because I've got a QR code. Anthony Barrios, he is one of our Salt Lake County loan officers. If you want to scan that QR code, he's fantastic to work with up there. We've got Tori Larson, who's up in Davis County, our neighbor up north. And I'm gonna hover over mine the longest because, hey, I want you guys to work with me as well. As far as these one-on-one financial things go, I can do these meetings over Zoom, over Teams. We can sit down in person. I've got offices in Saratoga Springs and in Orem. So if you're down this direction, I'd be happy to meet with you in person, or you're welcome to come join me for an online meeting. They usually take about a half an hour, 45 minutes or so, and we go over your income, we go over your debts, we go over your savings, we go over the different loan options, get you a plan so you know exactly what you're doing. With that said, I think we're ready to start looking at questions and answers. Do we have any comments in there, Brittany?
Yeah, we do have some questions. The first one is, does FHA require private mortgage insurance?
So yes, FHA does. I'm actually going to use a different term for FHA. It's FHA mortgage insurance. Private mortgage insurance basically means that it's backed from a private insurance company. FHA is it's the exact same thing. It's just backed by FHA, the Federal Housing Authority. One of the things with FHA mortgage insurance, though, is it never goes away. So on private mortgage insurance, after you've paid your balance down on your mortgage, the mortgage insurance goes away. FHA mortgage insurance, you have to pay it for the entire life of the loan. So a huge disadvantage on that FHA loan there.
Yeah. All right, next question. How long does pre-approval last for?
So pre-approval, that's a great question. It really lasts for as long as your documentation is good. Okay. Credit reports, for example, are good for 90 to 120 days. And so if I did a pre-qualification for you right now and you didn't find a house for the longest time, after 90 days, I'm gonna have to pull a new credit report for you. Your bank statements are only good for 30 days. Your pay stubs are only good for 30 days. And so a lot of that stuff can be renewed, but generally speaking, a pre-qualification is good for 30 days, but that only really means that I have to get updated pay stubs, updated bank statements to validate that you haven't lost your job, that kind of thing. I've had pre-qualifications that have been open for 6 months, and we just have to pull credit again on them. With that said, when it talks about a pre-qualification, I don't, the way I define it as far as the time when we want to actually go to the point of doing an application and pulling credit on you is the point where you're ready to start looking at homes. If you're just kind of wanting to explore your options, that's where that consultation comes into place. And then we do a pre-qualification when you're ready to start looking at homes. Because I'm hoping that you find something within 30 to 60 days.
Next question. Does Mountain America have a construction loan that rolls into a mortgage? And are the qualifications very different?
Absolutely, we do. It's called a one-time close, is what you're describing there. The qualifications are really basically the same. We're looking at credit, income, and savings. The biggest difference between a construction loan and, say, your typical first-time homebuyer program is you do have to have a minimum of 5% down payment, and you're not going to have a seller paying your closing costs because you're building the house instead of buying it from a seller. And so generally it just requires additional cash. Okay. Is the biggest difference.
We've got another question. Is first-time homebuyer literal, or is it a certain amount of time has passed since your last home ownership? Can you qualify as a first-timer again?
Yeah, so the way we define that is if you haven't owned a home in the last 3 years.
That's a great question, Becky.
Yep.
Okay, and then what are your thoughts on buying down interest rate? Is that possible being a first-time home buyer or no? And is it worth it?
Great question. That is a great question. So each loan program is different. Okay, so for example, our Mountain America first-time home buyer program, we do not have a rate buy down option on that one. FHA generally does not, but sometimes does. Conventional loans sometimes do. Let's talk about what it is though. Okay. So basically what a rate buy down is, well, there's actually two types of rate buy downs. You've got your permanent rate buy down and you have your temporary rate buy down. Temporary but rate buy down, in my opinion, it's kind of a shell game, right? Basically what you're doing is you're prepaying interest so that you feel like you have a lower interest rate for 1 or 2 years, but your actual interest rate is the same. It's just, so basically you pay $10,000, $20,000 to prepay your interest for 1 or 2 years. Your interest rate is actually 7% or something like that, but it feels like it's 5% for the first year, and then it adjusts up to 6, and then to 7% down the road. So you're not actually getting a better interest rate. You're just prepaying a bunch of interest so that your monthly payments for the first little while feel lower. So it's a little bit of a shell game because you're not actually saving money. It just falsely makes your payment feel lower because you've prepaid some of your payment up front. The other kind is a permanent rate buy down. Basically what you're doing there is you're paying a fee to buy your interest rate down. So say you're paying an extra $10,000 to move your interest rate from 7% to 6.75% or 6.5% or something like that. And your interest rate is permanently down to 6.5% for the entire life of your loan. But that can be beneficial sometimes, it sometimes won't. So for example, if you're lowering your interest rate and that lowers your payment by $100, but it costs you $10,000 to do that, well, we do some math there. Let me grab my calculator. So we say, all right, well, it cost you $10,000 to lower your interest rate, and that saved you $100 a month. Well, that's a 100-month break-even period, meaning that you only save money if you keep that mortgage for at least 100 months. And so if you think you're going to sell the house in less than 100 months, or you're going to refinance that mortgage because rates are getting better in less than 100 months, well, you didn't actually save any money. Yeah, you lowered your interest rate and you saved $100 a month, but it cost you $10,000 to do that. It wasn't a net benefit to you. My thoughts right now is it's probably not worth it to do a rate buy down. It's tempting because it lowers your monthly payment, but most likely in the next year or 2 or 3, we're going to be talking about 5%, maybe even 4% interest rates, and you're going to want to refinance. And that money that you paid up front to get a lower interest rate is now just sunk money. Yeah. So we can definitely evaluate that to see if it makes sense for your situation, but that's what you're doing. You're prepaying fees to get a lower interest rate, and it may or may not benefit you in the long run. Great question.
Yeah, lots of great questions. Any last questions before we sign off? This has been wonderful. Thank you so much, Brett.
Yeah, you're welcome. My pleasure. My request to you guys is, reach out to us, right? Reach out to one of us. See if we can go through your individual situation. Like I said, that meeting usually takes about 40 to 50 minutes or so. We'll go through all your details, get you a plan so you know exactly what it looks like to buy a house. My favorite time to meet with people is 6 to 12 months before they're ready to buy a house, so that they can be planning and preparing the right way so that they know what they're getting themselves into.
Awesome. Well, thank you again so much. Oh, Julissa has a comment. Is there a way to get this presentation emailed to us? Julissa, this is actually been recorded and everyone can go back and view this later. We'll have it posted on our Healthy Lifestyles website, and it will go out in a weekly lineup email as well. We have a lot of thank yous coming in. This presentation was so wonderful, great information. So again, Brett, thank you so much for your time. Really appreciate the additional education.
Yeah, just wait until we do that face-to-face, one-on-one. It's just that much better, so you know exactly how the math affects you and your individual situation. So
fantastic. Thank you, Brett. Have a wonderful rest of your day, and thank you for all of those that were on this workshop today, and we'll see you soon.
Okay, thank you.
Cassandra, the code for the WellSteps, so all you have to do is log into your WellSteps account, and then you'll check off the presentation that you attended. And this one's the Beginner's Guide to Buying Your First Home. And you can just go in there along with all the other workshops as well and check it off there. So no need to sign in.
Okay, I just was, for some reason, I thought it needed something for it to go through. So I'll probably just need to try it again.
Yeah, no, I'm sorry. I misunderstood. So yeah, so your username is just your EIN and then whatever password you created. But if it's not letting you in, try resetting your password.
Oh no, like I'm in. I just, when I go to hit it, let me see if I can do it right now while I'm talking to you so I can show or tell you what it's telling me.
Yeah, for sure.
Sorry. Yeah, because I'm in and I was able to find it on there. I just thought it was having me put in some kind of code or something.
Is it still doing that right now?
I am trying to find where it went. Okay, there it is.
Let
So
me
I
pull
hit
it
the
up on my
little
end too.
check mark and it says this activity may be checked off when there's a value in the provided field. So do I just put the number that it was worth? Because it's worth 10 or something.
So underneath it, it's asking, there's a comment box, right?
Oh, yes, yes. Okay, perfect. I just got to fill that in then.
Yeah, so you'll just engage with the question that it's asking and then you're good to go.
Perfect. Okay, thank you.
Yes, of course. Have a great day.